Arun, at face value, when I first saw the headlines this morning, it was a profit beat, a revenue beat, an upping of the forecast for the full year. Why are people so focused on what's happening with the pet food side of things overall?
Yeah. Hey, Dom. Yeah. You think it's a sure recipe for a good quarter, good top line beat, good bottom line beat, and the guidance raise. But if you dive a little deeper into the results, you saw some pretty significant weakness in their pet segment, which has historically been General Mills' fastest growing segment. Recall they bought this company, Blue Buffalo, in 2018 for $8 billion. A big acquisition there. And it's really been a really top performer. This segment has been a really top performer since the acquisition. And this quarter, we saw flat sales growth. Volumes actually declined 11%. What's also equally concerning is that profit margins in that pet segment has significantly deteriorated. And although General Mills is pretty confident that sales will bounce back next quarter in the pet segment, they didn't sound as confident that operating profits or margins would bounce back in that segment. And a lot of that has to do with the things that we've all been talking about: cost pressures, supply chain pressures, lots of ingredients in dog food. So those things are there are more acute supply chain challenges there for this company. So that's one of the reasons that we did lower our rating and our price target today. It's the ongoing weakness that we're expecting in pet. And we just think in general, I think these packaged food companies are entering a much more challenging operating environment next year. These companies, packaged food companies, really haven't had to work that hard to generate sales growth over the past few years, but that's starting to quickly change. And I think we saw that this quarter. So I think the next year is going to be a little bit more challenging for General Mills. So we're advising clients to take profits now and wait for a better entry point.
By the way, Arun, if you look at the chart over the last year, General Mills has been an outperformer compared to the rest of the market here. There's been a lot of focus on consumer staples. I'm the owner of multiple dogs myself in our household. We know what we spend on pet food. It's going up in price. We also know, though, that we spent a lot on packaged goods during the pandemic. How much of this is about this notion that it's a tough comparison, so to speak, going forward versus the spending on packaged food and specifically pet foods over the last few years during the virus pandemic?
Yeah, it's a combination of both. 2020 and 2021, we saw the really strong demand that boosted sales for General Mills and packaged foods. And then late 2021, 2022, it was really higher prices that boosted sales. And it's a combination of higher prices and relatively strong demand, meaning elasticities are relatively strong for really all these packaged food companies. So that's what I meant by what I said is that these companies didn't really have to work that hard to generate sales growth over the past 2 to 3 years. But that's starting to quickly change. Demand is moderating. We're seeing that. We saw that this quarter for General Mills. And starting next year, they're going to be lapping these price increases from 2021, 2022. So it's going to be much more challenging to generate top line growth. And I think a lot of these companies, General Mills included, is going to have to do things like increase advertising, promotional spending. These are the things, focus on innovation. These are the kind of things that the companies need to invest in to really generate top line growth. Which could impact the bottom line. So one of our theses for our downgrade today is the whole profitability and margin side of the story. So even though these companies might generate maybe mid-single digit sales growth next year, we don't necessarily see that flow to the bottom line because of all these cost pressures and investments these companies have to make.
All right. So General Mills, it's now sell rated in your universe. That means that there has to be a favorite pick in packaged food or consumer staples. What is it?
Yeah, so our top pick in packaged food is Mondelez International. They're predominantly a snacking company. Snacking is one of the fastest growing categories in the center of the grocery store. So if you're a packaged food company, you want to compete in snacking. That's what every packaged food company is kind of slowly gravitating towards. And Mondelez is the leader in snacking. Other reasons we like Mondelez International is they have relatively low private label exposure. So right now with consumers trading down to maybe store brands, that isn't materially impacting Mondelez International because of their relatively low exposure to private label. They also have relatively low food away from home exposure. They mainly sell products at the grocery store. So that's a positive given recession risk in 2023. And another reason we like Mondelez International is they're predominantly an international company. Only 25% of Mondelez's sales are in the United States. And now that we're starting to see the U.S. dollar kind of, slowly come back down to earth,
right?
What was a big FX headwind this past year could turn into a pretty, sizable FX tailwind in 2023.
All right, Arun Sundaram at CFRA with the topic as Mondelez. Thank you very much. We'll talk to you soon.